Have you ever wondered why you know so little about the insurance industry? What happens when you transfer a risk to an insurance company? How do insurance companies manage all those risks that they accumulate? And what in the world is cyber insurance, and why should you be more involved in sourcing or placing it? Now, these are hard questions, but we have to start somewhere. Cyber insurance has been around for over 25 years, and yet insurers, regulators, and many organizations still have existential questions about the cyber insurance marketplace. But let's think about it. Data and technology has underpinned our society's wealth and aspirations. Technology has improved our way of life, our businesses, and it has given us hope that we can solve the world's biggest challenges. But securing this technology is in itself a problem. And that's for two reasons. On one hand, everything is more or less connected. And on the other hand, human error is omnipresent in cyber risk. So these two reasons make it very hard to predict cyber risk. So what can we do about it? How do we solve this? Well, we could lean into our human superpower, our communication skills. We need to be able to engage and share knowledge, opinions, efforts, so that we can better understand and be better prepared for cyber risk management. It's what I would like to call our collective intelligence. So today, we are going to build up our collective intelligence around the topic of cyber insurance. So not too long ago, I was at a dinner party on a Friday night, great times, surrounded by new friends and friends that I've known for a few decades. Just before dessert, I heard my name and a loud gasp across the dinner table, something you probably don't want to hear. Monica works in cyber insurance. Now, I really wish I had the epiphany to say, no, really, I don't work in insurance. I'm a piano player at a jazz bar, or a professional dessert taster, because I love dessert. But alas, I had to respond and say, I am an underwriter, a taker of risk. I've spent the last 12 years working alongside different professionals in the insurance industry. I've seen how insurance companies evaluate and assume risk. I've seen how brokers influence the cyber insurance marketplace. And I've also seen how many organizations still struggle with understanding cyber risk management. So today, it's my pleasure to be your Sherpa of insurance and take you or guide you on a journey about what is insurance. So we will start off by understanding what is insurance, what is cyber insurance, how do insurance companies operate, how do they risk manage, and why does it all matter? So risk does come from not knowing what you're doing, and insurance is there to protect you from the inevitable, from when life decides to throw you a curveball. You put a little bit of money aside each month or year, and the insurance company promises to pay you back. It's really an instrument that you use when you're trying to explore or you're experimenting with something. And that's because you really don't know what you're doing. In the process of innovation, you need a partner in crime to have your back when something goes wrong. But then insurance is also there to protect you from yourself when you think you know too much and you are too certain about something. Because there is always going to be the unexpected, the things that can go wrong without you even anticipating. So the story of insurance dates back to ancient civilization in Greece and Babylon, where people understood this very concept of protecting one another from a bad day. And they invested in putting money aside when a family death happened or sickness. And then in the 14th century, in Genoa, a place in Italy, the first insurance contract was drafted. And it didn't really look like an insurance contract that you see today. It was more like a loan. So let's pretend you're the ship owner and I am the bank. You borrow money from me to cover the cost of your voyage. And then in return, I will ask for the ship to secure the loan. If the ship is damaged or lost at sea, you don't need to pay me back. Sounds like a pretty good deal, right? Well, I get a higher interest rate in return for giving you the privilege of not returning the ship. So it doesn't really sound like the banks were getting a really good deal, does it? So they decided to separate these insurance contracts from the loan itself. Fast forward a few centuries, we have the rise of cyber insurance in the 1990s. It was really off the back of the millennium, where we saw introduction of data and technology, that cyber insurance policies became a thing. The name cyber insurance, in fact, has a nice story behind it, because we have to thank somebody in the AIG marketing machine for that name. It's a pretty sexy way, but confusing way of naming internet liability or information security policies. But alas, it really did sell more insurance. One of my favorite things is about the cyber insurance name is that I think secretly at AIG, somebody was a William Gibson fan, the gentleman who coined the term cyberspace. And one of his quotes was that when he looked at this term cyberspace, he said, it meant something, or it might mean something. But as I stared at it, my whole delight is that it meant nothing. Well, cyber insurance certainly means something today. And it was not always the case, because in the first decade of cyber insurance, no organization really was interested in purchasing it. And that's because they thought it was only going to be technology companies that have to deal with cyber risk, or it's only really if a contract required it. But from 2014 onwards, the cyber insurance market started to develop pretty quickly. And that was to do with more privacy regulations being implemented, but also we saw some of the first cyber losses occurring. Lloyd's of London, during that time, introduced a mutation of coverage called first-party coverage, or what you will know as your own costs and expenses being covered. Prior to Lloyd's of London introducing this, you had only third-party liabilities covered, and we will learn more about these concepts in the next few slides. But this mutation of coverage really changed the game in terms of how losses developed in the cyber insurance industry and what we see today. So let's backtrack to the genesis of cyber insurance. And please bear with me as we go through this fabulous insurance tree. You have two types of insurance: life insurance and non-life insurance. Now, life insurance is pretty easy, I would say, but quite morbid. It pays if you die. Non-life insurance, however, is a bit more complex, but basically it protects your physical possessions or your non-physical possessions. Non-life insurance is then split again into two: casualty insurance and property insurance. Now, casualty insurance is there to protect you from claims from third parties because you've had an injury to another person or an injury to their property. These are what we call third-party liabilities. Property insurance is there to cover your loss of property or damage to your property. So this is called first party, your own costs and expenses. So this could be your home, your personal belongings. To go deeper down the rabbit hole, casualty is split into three. You have specialty insurance, general liability insurance, and auto insurance. In the category of specialty insurance, you have all these wonderful products that you can see above me. one of which is cyber insurance. Now, all of these products that you can see up there, including directors and officers insurance, D&O, or crime insurance, all work together to cover losses arising from a cyber event. So this name cyber insurance, in fact, does not cover all the other insurance products that are actually needed to cover you from a cyber event. In fact, if you want to get coverage for property damage or bodily injury, you need to purchase property insurance or general liability insurance. And that's because at the moment, the cyber insurance market is not developed enough from a capital perspective to really cover the exposures that a bodily injury claim can give or a property damage loss. So you may be wondering, how big is the cyber insurance market then? Well, here are some estimates. These numbers represent the gross written premiums, so the amount of money collected by the insurance industry as a whole, and then it narrows it down to the cyber insurance market. As you can see, $7 trillion of insurance, in terms of GWP, gross written premium, is much, much bigger than the $10 billion that the cyber insurance market currently has in play. Now, why is this the case? Well, the cyber insurance market has gone through a growth spurt in the last few years. And to give you some context, about 5 years ago, the market was half the size it is today. In 5 years from now, the market is estimated to double to $20 billion. But this ambitious growth spurt is pretty unique because the insurance, or cyber insurance, is not mandated or regulated yet. So take auto liability, for example. You have a $400 billion market because drivers are required to purchase insurance to be legally allowed to drive. And then you have directors and officers insurance, which is not represented up there. But to give you a context, because it is one of the most favorite types of specialty insurance being bought, because it protects individual officers and directors from their liabilities, that's $20 billion in today's terms. But the origins of the D&O insurance product was from the 1930s. And during the 1960s and 70s, that's when you saw the biggest increase in D&O insurance. So that's about 60 years ago. So how do insurance companies operate? How do they make money? For this, I would like to introduce you to our motley crew of characters. First up, we have the policyholder. This is the main star, the star of our show today. The reason for this is that it's actually a combination of characters that make up the policyholder. It's all of you, trying to risk manage cyber every single day. And so it's either that you benefit from cyber insurance coverage or that you help procure the information to place it. The policyholder is also known as the first party because they are the most important party to the contract of insurance. Then we have the brokers. These troopers ensure that everything runs smoothly. They're like the operations managers, the information ambassadors. They run back and forth from the insurance company to the policyholder to try to transmit information and get the best deal. They can either clarify things or they can add to the confusion of what is cyber risk management. The insurance company is really where the magic happens. These are the underwriters. The insurance company is considered to be the second party to the contract. Now, you may wonder who is the third party then. We did cover it briefly to say that a third party could be a shareholder, a customer, or any other third party that can claim against the policyholder. And then we have the regulators, who are a very important player, but we consider them to be background cast at most times. And that's because they're there to keep an eye on things, to make sure that if there are any standards or guidance that needs to be provided, they're there to help. And then last, but certainly not least, we have the reinsurance companies, the reinsurers. These are the Batmans to our Supermans. They are the Bruce Wayne money. If something bad happens, if there's many different losses, if there's risky business being taken on by insurance companies, they step in and save the day. So how do insurance companies make money? Well, in 3 simple steps. Number 1, they accept premiums. They accept premiums because they accept the risk that goes along with it. Once they accept the premiums, they are able to invest them. And that is a secondary source of income, what we call the investment income. So between the time that you pay your premium for your insurance policy and the time that you go and claim against it, that amount of money needs to be put to work, and I'll explain why. So it's really what we call the float, the time between you pay the money and you claim against the policy. And step number 3 is that they have to pay out losses. And they also have to pay their own expenses. These expenses could be, of course, salaries, but there's also brokers' commissions, there's reinsurance costs, and of course, all the travel expenses. In a good year, you make a net profit or a margin. What that means is that you have more premiums collected than the amount of losses or expenses that you have to pay out. That is an underwriting profit. If you don't have enough premiums, and therefore you have more losses and expenses to pay for, you're making an underwriting loss. But it could still be a good day if your investment income is greater than your underwriting loss. And that's what you would hope for. Now for the million-dollar question. How do insurance companies price risk? How do they know how much to charge me for my cyber insurance premium? I wish we could play Who Wants to Be a Millionaire and pick some of these answers. But most of you may actually be thinking that it's a crystal ball, or that there's some sort of magic that happens behind the scenes. And I really wish that it was like that. It would seem more fun. But what really happens is that you look at a prediction of future cost of losses. And you use statistical analysis based on past loss experience. You use the underwriter's knowledge about what risks they're taking, why they're taking them, and the actuary's knowledge, the actuarial analysis. Now, actuaries, if you haven't heard about them before, they're like mathematicians, the wizards of the insurance companies. They help price things, and they help anticipate and manage claims. And the way they do that is they look at 2 types of analysis. They look at pure premium costing, and they look at loss ratio basis costing. Sounds like pretty esoterical concepts, but pure premium is the cost that you have to charge per unit of exposure. And exposure is the information that you get by having conversations with the policyholder about how many assets do you have? Where do you operate? What sort of revenues do you generate at those assets? The other methodology that actuaries use, called loss ratio basis, is a base rate that changes with the amount of exposure that you take on. Sounds simple, right? Well, cyber insurance takes both of these concepts and blends them together to come up with pricing. If you start a new insurance line, you may not have the luxury of using these methodologies. So what you end up doing is you actually pool together risks based on common standards and conditions, and then you see what happens. You adjust your limits, your retentions, your deductibles, as you may want to call them, to be able to see what your profitability is like. So if pricing does sound like an art, it's partially an art, but the science tells us something different. The numbers say that the rate changes that occurred most recently from 2019 onto 2021 were really necessary to correct the profitability of the cyber insurance market. So what you see here is almost immaterial changes before 2020 in respect of the rate changes in the cyber insurance industry. And in some cases, you saw reductions. But suddenly, you saw a 9% rate change. That led to an 18% rate change, and then 70% and above. Bear in mind that these numbers are averages, so some books of business actually saw greater than 70% rate changes, and some books of business saw much less. But the reason why I'm showing you this is that it's important to understand how sudden price changes could occur in a market that is certainly still maturing. But let's dig deeper into the loss ratios, because we saw the pure premium and then the loss ratio basis. If we zoom out, we realize that actually the most impact on profitability comes from improved underwriting or risk selection criteria. When underwriters were trying to correct their decisions that they made prior to 2018 on what type of risk they were selecting, they introduced more rigorous underwriting around cybersecurity controls. And that had the most impact. But it also meant that 1 in 4 clients did not renew their policy or simply were denied coverage. And that's not really bad news. It just means that there was a lot of clearing up of risk that needed to happen. So if loss ratios are driven by improved underwriting, what happens in risk assessment? How do underwriters price for that exposure? Well, underwriters look at various exposure metrics, and those are the most important when driving price. Things like personal identifiable information, let's say, the quantum of that, or the revenues, or your geographic location, your operations model. Those are all things that they take into consideration from an exposure standpoint. And then they dig deeper into the governance of a company. Who is in charge? What sort of budget do you have in place? Do you have a dedicated governance for operational technology, or is it just embedded into your IT? They want to know who is in charge and who's managing the decision at the end of the day. Most importantly, they take a look at resilience. And that's conversations around your incident response plan, your backup recovery strategy, and how you plan on doing your business impact analysis. And one of the areas that never really gets discussed in terms of underwriting, at least publicly, is that underwriters take a look at the character of the organization that they're insuring. So what is your loss history? How did you remediate? How often do you engage in conversations with your insurance company about what you're doing and how you're doing it, giving them context about why you're making the decisions you're making? So once the risk assessment is done, you will get a price. And your broker will have a conversation with you around what is covered, what is not covered, and what needs to happen next. If you decide to accept the premium, you will have a new journey to go on. But when I say you, it's now the insurance company that has to risk manage all the risks that they've accepted. So how do they do that? Well, they have to ask some existential questions about the risk that they've accepted and how cyber risk manifests itself. Are there going to be multiple events in any one year? Are they going to occur in the same industry, in the same geography? How big could those losses be? Can there be a systemic loss that happens? They do have, let's say, conversations, but the more practical area where they spend a lot of time is the realistic disaster scenarios, where they look at how an event can manifest across the whole industry. Things like cloud outages or a large-scale data breach. And so when they realize that there's a lot of risk management to do, they fall back on two risk management techniques. One of them is reserving, and the other one is reinsurance. My slides have not cooperated, but reserving, to take it as a first topic, means that you are anticipating or managing the claims. So that means that a policyholder will call you up and say, I've experienced a cyber event, and therefore I have a loss to report. But they have no idea how big that loss is going to be. Well, it doesn't really matter, because the insurance company has to set aside some money to account for it. And then you have the losses that the policyholder does not even know that they have experienced yet. In that case, the insurance company has to make a best case scenario assumption and put aside some money for unexpected losses. Next thing you have is reinsurance as a risk management tool. And actually, this is the most important part of risk management for most insurance companies. Reinsurance is there just like insurance is for policyholders. It's basically insurance for insurance companies. You have to be able to reduce your risk of mispricing, because it's such a complex feat. And also, it has to reduce your risk of under-reserving, because it's never a perfect science. And reinsurers generally have been there to support the insurance market. But in the last couple of years, they've experienced some unusual loss years. You've had a doubling of losses over the course of a 5-year period, from something like 45 billion to about 100 billion. And then in 2022, we've seen about 130 billion of losses in the reinsurance industry. Now, this is on the backdrop of the market now only having about 260 billion of capital to share. So why is this a big problem? Or at least a challenge for the cyber insurance market? Well, if there is a capital crunch in the reinsurance market, there is less ability to spread the risk. Investors are also choosing to put their money somewhere else and not in the reinsurance market. The reinsurance market is the only reason why insurance companies can take on systemic risks for now. And through the realistic disaster scenarios that you plan, you may find out that there's things that cannot be covered because there's not enough capital in the market, things like cyber war. And we can have a whole other presentation on the controversy around those policy limitations. But the idea behind it is that there are uninsurable risks out there, considering the size of the insurance market and the reinsurance market. So when there isn't enough capital in the reinsurance market, it stifles the growth of the cyber insurance market. Most organizations are looking for quite a significant amount of capital when you're looking at the values that are at risk or things that you want insured. And when I say significant, I mean hundreds of millions versus, or sometimes billions, versus what the insurance company can offer on a one individual risk. Most insurance companies have about 25 million maximum to offer on any one risk. And organizations want 100+ million from that insurance company. And the only way to get there is to have more capital in the reinsurance market so that you have a way to spread the risk. But how do you then attract capital to the reinsurance market? Well, you need to be able to simplify. You need to be able to simplify the coverages. These are some opportunities, but I will focus on two main ones, which are coverage and the amount of information. So to simplify coverage, what we would like to see in the insurance industry are reasons why you want to buy that specific type of insurance. Whether you're looking to cover your business interruption costs, or you're looking for insuring, let's say, your incident response costs. If those insurance policies are more fit for purpose, you don't need to hold capital for things that you don't really need. So we can grow the reinsurance market with more simplicity around the coverage that we provide. That also gives you more certainty when you claim something against your insurance policy. If you tend to insure everything and anything, then you may get a situation where you weren't clear on what is actually covered and what is not covered. From an information standpoint, the reasons why you make the decisions you make around controls and processes needs to get to your insurance company somehow. And that's the only way that they can provide you with better premiums, better deductibles, and better risk management services. A lot of the times, there is no real challenge back to the insurance companies on why they're asking the questions that they're asking or how they should be asking them better. Now, the role of cyber insurance is there to complement all of your plans and risk management and reinforce your resilience. It is not there to protect you necessarily. It's not there to replace security. It's there as an additional tool. And that's one of the biggest myths that we see in the marketplace, is when there are no controls in place, you still have organizations that come to the insurance market and ask for that risk transfer to happen. So you've come with me on this journey through the trials and tribulations of PowerPoint. And I just wanted to really enforce what is currently happening in the cyber insurance market to give you the ability to anticipate and to respond to this. So prior to 2021, we were on this pink side of the insurance cycle, where rates were rising strongly and risk selection was top of mind. Now, as profitability has improved, you have new competition coming to the market, or existing players that have seen that they may have an ability to reduce cost or relax the risk selection criteria. That's never a good sign. If the risk reduction was actually palatable, and we could point to those controls and processes that led to that risk reducing, that would be great. But what we're afraid of is that there's simply just a market dynamic of more supply that is pushing down the rates. And so what I would like to ask of all of you is to hold the stakeholders involved in the insurance process accountable to respond to your questions about why are my insurance premiums suddenly coming down? Why did they go up so much last year? What sort of controls are having an impact on those decisions? And why are you bringing more coverage into the market when I've not asked for it? And that's because we really don't want to go through this cycle too quickly. The truth is that cyber insurance pricing will be more volatile than your auto insurance, your home insurance, any other type of insurance. And that's because it is evolving. It is adapting with the losses that we see. But the decisions that people make around those premiums coming up or down are important for you to understand and to incorporate into your cyber risk management. So cyber insurance or cyber risk has many participants, as we've talked about today, and they're all sharing their expertise on how to improve and to prepare for an event. What we really need is more conversation and more dialogue. One of the fundamental features of cyber risk or cyberspace is that it's all in constant contact. And yet we have not really been inspired by that constant contact to develop more conversation around topics like cyber insurance. So why shouldn't we keep engaged and keep discussing these important topics? Well, I'm hoping that today will serve as that impetus to build our collective intelligence around cyber insurance. Thank you very much for your time.